world has never done this before. We're on untrodden ground. It's allowing a small group of men and women to alter the course of world economic events. Are they more likely to make wise decisions than billions of people acting in a free market? I would suggest no. These central planners are continuously upping their bets. They continue to increase the potential that some event or events could rapidly change investor attitudes and markets could collapse. That's the risk when there's extreme leverage. We learned that very clearly in the aftermath of the dot-com frenzy and the housing bubble. Leverage can kill. And leverage in the world economy is worse today. Central banks seem to recognize clearly how dangerous the situation is. Europe is already in recession, and our Fed governors are bending every effort to prevent such an occurrence in this country. They fear that another recession could lead to a debt collapse like we're starting to see in Europe. So the Fed keeps stimulating more, which adds to the already extreme amount of economic leverage. Where and how does it end? I have no idea. Let's look at some of the most recent economic indicators, which would be starting on page 10 in your booklets. This is the ECRI leading index. ECRI stands for Economic Cycle Research Institute. And this group is historically one of the most accurate forecasters of coming economic activity. And ECRI's leading economist, Lakshman Achuthan, that's a tough name, indicates that the current forward statistics are forecasting a probable recession soon in the United States. We can see on the next page the most recent GDP statistics over on page 11. Economists talk about stall speed. Not everybody may have heard that term, but those of you who read business pages regularly or watch financial television have probably heard about it. And it basically refers to that level of economic growth that the country must exceed to avoid falling into recession. And over the past 4 decades, as these two side-by-side graphs show, we've rarely escaped recession with real GDP growth below 2%, which would be this line on the left chart. You can see we're just right about at it. We're at 2.1% now. So you've got an instance here, it kind of dipped under. We didn't get a recession. It dipped under here. And we didn't immediately get a recession. And so far, of course, it's coming up from the recessionary bottom. And now we don't know if we're going to go into a recession here. But we are on what has historically been a danger zone. And likewise, over in the nominal GDP, and by the way, the difference in this is the gross domestic product figure before subtracting inflation out, and this is the gross domestic product figure after subtracting inflation out. And on the nominal GDP, 4% tends to be the line of demarcation between, it's not to say that you can't have recessions up here, but every time it's gone down here into a 4% nominal, it's fallen into recession. And we're there. It's 4% right now. It's not below 4, although that's the thing. So right now we're on the edge of what has historically been stall speed. And if you haven't heard about the fiscal cliff yet, you will soon. It's likely to become a widely discussed and argued topic in the months ahead. And page 12 shows you the economic events that are scheduled for year end unless Congress extends or changes the conditions that exist now. And potential fiscal drags listed here. The Bush tax cuts expire, payroll tax reductions expire, CapEx bonus depreciation expires, unemployment benefits, that's extended unemployment benefits expire, and then automatic spending cuts, what they are calling the sequester. If Congress doesn't agree to specific cuts, there is to be a broad across-the-board cut in a variety of areas. Of course, we don't know what Congress will do. They may, especially in an election year, they may suddenly become very collegial and start agreeing on lots of things. That's possible. I don't imagine you or I or many in this room would bet on that. Various economists have estimated the economic impact on GDP depending on which or all of these either being extended or actually expiring. And you see quite a range of estimates, but they're all pretty significant. The highest impact I have seen is about a 5% decline in GDP in 2013. I read one research report this morning from ISI, a very respected research house, and they said, and they were doing some political factoring, they said given what they think is likely to happen in terms of agreements, disagreements, what they'll extend and so on, they thought the effect on 2013 GDP would be about 1.6%. If GDP is 2% real right now, and you go to 1.6 down, you drop 1.6 before you even start the year, you're down precious close to recessionary levels. So it'll be interesting to see what does come out of our enlightened legislators. Not that I would suggest that even if they do nothing that it's necessarily bad. I don't know that there are legitimate arguments for bad or good on both sides of this issue. This is a tough one. Turn to the page to foreign indicators now. 2012 foreign growth problems, both in Europe and in emerging countries. And I've got dozens and dozens of these things I look at. And so what I tried to do was, this was one that kind of combined a few things. It's 2 weeks old or so, but the data really have not changed. This is a Eurozone composite PMI, which is Purchasing Managers Index. And the Purchasing Managers Index is probably on a worldwide basis provides the best readings of current economic conditions. And they say this is a composite because they do Purchasing Managers Indexes both on manufacturing and on non-manufacturing, which is mostly service-type entities. So here you have a composite of the two. Reading in April is 47.4. 50 is the demarcation line between growth and contraction. So any number above 50 indicates growth. Any number below 50 indicates contraction. And you can see that the Eurozone composite is clearly under 50 in the contraction area and falling. China, this is the manufacturing PMI. This is 48.2. So in the manufacturing side, they are declining. And then they included down here, and one of the reasons I showed this is that it has the three all together. This shows European 600 banks stock index, and you can see, and this is 2 weeks ago, with what's happened to European banks in the last 2 weeks, that number is lower, and it's preciously close, or precariously close rather, to its 2009 crisis low. So the banking, at least the investors in European banks, are not very optimistic about economic conditions. More PMI readings are over on the next page. This again is from ISI, and they have a traditionally bullish outlook. That's ISI tends to be it's a very reputable research group, but with a bullish outlook. And here they're kind of throwing up their hands saying, wow, look at this stuff. These are non-Eurozone countries, and you'll see that there are two readings here on manufacturing PMIs. This is the month-to-month change from March to April, and then this is the overall rating, and you see that half of these